welcome to today's seminar on wealth management presented by our founding director, Dean Vanessa Jameson. My name's Hayley and I've been with the firm for nearly a decade as boss. First, I'd like to introduce you to Dean, who co-founded the business with Vanessa in 2006. Dean is our leading chief investment officer and has a wealth of knowledge and experience in investment markets. Dean has spoken at numerous seminars worldwide, sharing his insight and best practices. Now it's my pleasure to introduce you to Vanessa, the Director of Positive Dynamics, a leading provider of wealth management solutions. Vanessa has been instrumental in the firm's success, bringing her extensive expertise and experience to the table. Vanessa is a trailblazer in the financial industry and is passionate about helping clients achieve their financial goals. So please join me in welcoming Vanessa and Dean as they speak insights and inspiration with us all.
Thank you very much, Hayley. Well, thank you for coming along. For those that could join in person and also those that have joined us online. How is everyone feeling? Good. Excellent. Great. Now, I just want to say as well, we've got some work booklets. If you're online and you haven't received the work booklet, just email through to info@positivedynamics.com.au and we shall get you a copy across there shortly. So tonight's seminar is on wealth management, and I'm really excited because tonight not only will you hear from me, but you'll also hear from Dane, who is the head of our portfolio management. But I'll get started and let me just find where I'm going. Perfect. A bit of an introduction to the team. So Dane and I started the business, as Hayley said, in 2006. So we've had the business now for 17 years, and we've been through a couple of interesting times. One that we would remember is global financial crisis, and one more recently is the COVID pandemic. So there's Dane and I. We co-founded the business. We have a great advisor team. Justine is joining us here today. And there's also Natalie and Hardik, so hopefully you'll get the chance to meet them at some time in the future. I would like to tell you a little bit more about Dane and myself so that you can get to know us a little bit better. And what we've got here is a bit of a story that's going to set the scene for what we're going to talk about today. So you're looking at a picture or some pictures of myself and Dane. We took an adventure down to Tasmania. It was in December of some years previous, and we were told that you never know what the weather's going to be like. It's summer, so it could be really warm, or a storm could suddenly come through and you could find yourself in snow. So we thought, okay, we need to have some professional guidance on this trek. It was a 4-day trek, and we also want to make sure that we prepare the right gear. We want to be diversified to help us be prepared for whatever event may come our way. So as you'll see, we set off. It was a beautiful sunny day, and we were climbing this big mountain. We got to the top of the hill after many hours, and a storm. The weather suddenly changed, and a storm kind of came in. And next thing we found, it was snowing, so we crept inside our tents and found shelter for the night. So here we are, up on the top of a mountain, and it starts to become bitterly cold. So we've got our day packs and our packs that we've had, carrying all our gear, and in a nice warm sleeping bag, but I find myself freezing cold. So the first thing I do is I put on all of my socks. So I've got 2 pairs of socks on. I've got my long thermals, long sleeve, top and bottom. I have my day pants over the top, my fleece, my fluffy jacket, my vest, my scarf, my beanie that I've pulled over nice and tight, and I'm also wearing my snow gloves because I cannot feel my fingertips, nor can I feel my toes. So here I am a couple of hours in, and I'm wondering how I'm going to get through the night. And I actually start to think I'm probably going to have to leave tomorrow. I'm not going to get through this trek. But there was a couple of things that I learned from this, and they really apply to what we're going to talk about today. I learned that diversification is really important. I had cold feet, but if I had packed my day pack with only socks, I would have found that I had really warm feet, but the rest of my body would have been quite exposed. And the good story is that I did manage to continue and finish the trek because we had professional guides. That was the coldest night, and we really were able to adjust to the conditions. It was cold, but we got through. So now that I've set the scene, what I'm going to do is I'm going to hand over to Dane.
All right, guys. Dane Jansen. Thank you very much again for coming tonight. General advice warning: any information we provide tonight is general advice. And if you'd like any actual personal advice, please feel free to reach out at any time. But anything that we discuss tonight will be general in nature, and may not, well, probably won't reach your personal needs. And look, I just want to start by, off the back of, as what Vanessa was saying, diversification. Diversification we find is really, really crucial for what we do with wealth management and investment markets. So just going to briefly go over a few of the investment vehicles that we use. Shares, ETFs, managed funds, bit of property. Won't touch on crypto tonight though. So again, it's one of those things. If you're looking for some specific crypto information, we can have a chat about that further. But tonight we'll cover off the other basic fundamentals of investment and other investment vehicles. All right, so our positive numbers here. We model and manage our own portfolios. One of the key criteria of that is dealing with the stock market, so shares. So shares, stocks, you may have heard it called different terms. It means the same thing, but essentially shares represent the equity of ownership in a corporate or financial asset owned by an investor who exchanges their capital for the returns of these units, right? So most companies have shares. Do we have any business owners? Private business has shares, and you may be a 100% shareholder in your own business. But what we're talking about in this instance is publicly listed companies that are traded on a stock exchange. So a few of the stock exchanges that people will be or maybe understand and that are available. The ASX, Australian Stock Exchange, so that's what we trade here in Australia. New York Stock Exchange, so obviously based in the US, biggest in the world. And NASDAQ, that's predominantly for tech companies, sort of more outside of that direct scope. So, but there's stock exchanges all over the world, so it gives us opportunity to invest in a lot of different areas. So, as I was saying, many different stock exchanges. New York Stock Exchange and the NASDAQ being the two largest. And we can see down here, the ASX only makes up, not quite 2% of the overall, market, global markets that we have the opportunity to invest in. So you can see really large opportunities with these markets. Down to what we've got here with the Australian market, and so many in between. So you've got different parts of Asia, Hong Kong, Japan. So everyone has their own different exchange that gives you the opportunity to invest. So, all right. So back to investment vehicles. So exchange traded funds is something that I mentioned before. Okay. So an exchange traded fund is what we look to here at Positive Domains. We use ETFs or exchange traded funds quite a bit. So essentially what these are, they're a package of shares wrapped up as a fund, which we can buy as a particular fund purchase on a stock exchange. So as I said, we rely on the ASX for those particular investments. There's some really great value in doing this. They're cost effective, but they give you a broad range of assets under that particular investment. So back in the day, before we had opportunity to use these exchange traded funds and those sorts of things, you'd have to be buying direct shares. So this gives you the opportunity to buy shares in smaller amounts, but still purchase it as one purchase. So they give you a lot of liquidity. They're easy to move on. We can trade them on a daily basis. really handy vehicles to be able to use in our portfolio. So. All right, so another investment vehicle, as you would notice on that first slide, was managed funds. So a managed fund is one of the oldest forms of a managed style investment. So again, this gives you opportunity to invest in lots of different companies, but with only one sort of point of contact. So the difference between a managed fund and an exchange traded fund is the managed funds are based on what's called a unit trust. So essentially you rely on a fund manager to make those choices of what the underlying assets are going to be, and you actually purchase units in their trust. It comes with some benefits. Obviously, you're relying on some expertise of these different funds managers, but it actually comes with some setbacks also. They will always retain beneficial ownership of those underlying assets. So it doesn't mean a lot to the general public as a whole. We still get all of the capital gains that are offered. We get generally all of the income that is offered, but they do have an opportunity to utilise their tax position internally without passing that on. So that's where the beneficial ownership of those managed funds doesn't necessarily always benefit the end user, but a really, really handy tool and a great valuable asset that we have in our portfolio. So
now, thank you, Dane. Now that Dane's explained what shares are, what exchange traded funds and managed funds and how they all fit in and have a different purpose, I would like to just go through how investments have returned over time. So what we're looking at here is an index chart, and it's tracking investment returns from 1950, and then these are the years all along to the end of 2021. So it's the most recent chart of this type that's available. I haven't updated it for 2023 just yet, but it gives us a really good idea on our understanding of how different investments work. So if we look at this in 1950, and you had $100 in 1950, so you're probably going back to your parents' age or potentially your grandparents' age. In 1950, they had $100. They put it into a bank account. That $100, we can see what it's done over time. It's this smooth line that we're following here. $100 would be worth about $6,600 today. We're not really taking any risk. It's in a bank account. It's just slowly growing over time. If we compare that to the Australian share market, and we just held the top 200 shares in Australia, and we held that for the same period of time, you'll see the dark blue line here. It's volatile, it's up and down, but you'll see overall it's growing, and that has grown to 307,000 over exactly the same period of time. So that's a stark difference from cash to Australian shares. The other lines, just to quickly explain them, the green line's bonds. So if you had bonds over the same period of time, we're taking a little bit more risk than cash, but it's still quite a secure investment. It can be a little bit volatile at times, but that would be worth about 17,000 over the same period of time. And then an example of if we tie a number of different assets together. So when I say that, we're looking at having some cash and fixed interest, some Australian shares, also some international shares, which aren't shown on this chart, but they act very much like the Australian share market. And we can see this blue line. So this is what they refer to as a balanced investment fund. And, if we've got superannuation, it's quite common that we see a default option in the superannuation. So when I say default, your employer set you up, you haven't made any change to the investment. Quite often we'll see a super invested just like this. That light blue line where $100 over the same period of time equals 135,000. So we like to go through this so that we can understand now, one, what different asset classes will do, how volatile they can be at different times. So then we can understand how we can package your portfolio. So some examples. This is 1987. The Australian share market fell about 50%. But it did recover, it took some time. So if we had time on our side, we're okay. If we were retired, that would be absolutely devastating because we wouldn't be able to recover from that event. But if we have time, if we're looking to retire in 10, 20 years, we still would have made more money investing that way than we would have putting it in cash. The same can be said from global financial crisis. The share market had a similar drop. It was around a 50% drop. It was over a longer period of time, not just in one day. But it was similar in the recovery period. But as long as we had time on our side, we were okay. It was the people that were leading into retirement, if you can think of anyone that was at that time, they're the people that it really hurt, because if you don't look at how your investments are allocated, you can really be caught out. And that's where you think about the story I said earlier. They're not prepared for the storm that could come. And we never know when the storms will arise. So that's why it's really important to have a look at our asset allocation and make sure we're prepared. So in saying that, I'm going to hand back over to Dane.
Thank you, Vanessa. As Vanessa was saying, obviously, you get this, you can have amazing returns, particularly in the stock market. The ASX over that time, 11.8% is what that little number was up in the right-hand side if you couldn't see it. But that's a fantastic return over that time. Our philosophy here at Positive Dynamics, we base everything on our investment philosophy. So, though the Australian market is absolutely phenomenal and has really great opportunities, as you can see on that slide a lot earlier, the US make up a massive amount of that global market. Australia is only quite a small sector of that. So therefore, we don't believe that you need to be 100% into the Australian market. There's a global diversity which we believe in. There's many different markets around the world. We've got the US, as we mentioned. Europe have got their own markets. Asia, their emerging markets. There's really great opportunities all around the world. So we don't believe that any one particular region is the perfect place to invest. We believe that they all have a great opportunity and a great purpose in our portfolios. So, at the moment, as Vanessa was saying, Australia looks great, but also we have a lot of ability to go broader than that. And that's one of the things that we believe we do here differently at Positive Dynamics. A lot of funds managers or asset managers in Australia have particularly a home bias to invest in Australia because they're comfortable. They don't go out of that comfort zone to look at different regions where they can actually take better opportunities. There are different sectors in different regions that you can invest in. So Australia is great for resources and great for financials, but not necessarily from a tech perspective or healthcare, which you can pick those up. Tech is really great asset out of the US. Healthcare out of Europe. So it's about looking at those different regions that can really help us out. When we look at modelling our portfolios, we look at a core part of the portfolio and then what we class as satellites. So core part of the portfolio is really looking at that regional diversity where we can look at different indexes. So an index is what they class as a passive investment. Have we all heard of the firm Vanguard? So Vanguard are a big believer in passive investments. There's a lot of research to back the fact that if you only invest in the index, which is, let's say, the S&P 500 or the ASX 200, that's top 200 companies in Australia. If you just set and forget and write out all of those ups and downs, you'll have positive returns at the end of the day. They're low-cost options that actually track the market up and down, which is fantastic. But you'll only ever track the market. So what we look to do is, pair that with what we class as satellite investments. So this can be an active style management, that can be different sectors, as I said, healthcare in Europe, tech, those sorts of things. But active management, they can still particularly invest in those same indexes. So let's say the S&P 500, for example. But what an active manager does, they'll charge you a higher management fee on their fund, but that we're paying them because of their expertise. So we pay them slightly higher, but that is so that they can go through that top 500 companies in the US and maybe pick 20 or 100 of them that they believe are going to shoot the lights out. And that's where we believe in their expertise, and that's where at Positive Dynamics we look to find the best managers, ones that we believe that are going to do the best job for what we're paying them for, but not only for that upside, but also from a downside protection. So, and with the consideration of the COVID crash that we had, a really good active manager can mitigate that downside, which realistically helps you when there's a recovery at hand. If you haven't corrected as far as the next bloke, you've got a lot more opportunity to make that growth moving forward. So that's where we pair the core and the satellite, which is that passive and active approach to investing. So, all right, so a bit of a market update on what we're seeing as winning sectors at the moment. So, as I said, we're a big believer in healthcare. That healthcare sector around the world has been really great, particularly the last few years. We've seen COVID. There's been a massive growth in that. But also from a protection perspective, they're a really good defensive asset to hold. Though their growth and though they continue to push our portfolios forward, they do offer that downside protection because everyone needs healthcare. We have an aging population. As we're getting older, we need more medication. We need access to doctors. Overall, it's a growing sector and will be into the future. Resources is going to be a winner moving forward. Resources always does really well, or I should say always, but predominantly does very well. But we look at what's happened out of the back of COVID again. China had their big shutdown. They're now opening up to the rest of the world. They buy a lot of their resources off us, and we're a very resource and mineral-rich country. So it's always good for Australian equities and resources in Australia to be able to supply that to the world. And another one of the sectors that we really believe in, and we believe that there's has been great and will continue to be great moving forward, is anything to do with battery and lithium technologies. So electric cars are just becoming more prevalent, more demand for them. But even from houses, we're all getting solar panels, or most people have got solar panels on their homes. Now we're adding batteries to that to become more self-sufficient. So that way, any of the energy that we're collecting from the sun, we can actually store and reuse. So any of these rare earth minerals, we've got lithium, cobalts, coppers, all these sorts of things which come out many different countries, but predominantly here in Australia, we've got a really strong resource position for those minerals. There's some great sectors moving forward. So with regard to our portfolio construction, as I've said, we diversify. We don't have any one particular asset which we hold overweight or too heavy position in, and we don't have any particular region either. So we believe shares are critically important to our portfolios. You have amazing growth, you have amazing income opportunities from from shares. Property also is a fantastic option. We have a lot of property in our portfolios from the perspective of, we have our own homes, we have investment properties, but we also have property trusts, which we can model in our portfolios. So this gives you option of, let's say, Westfield shopping centres. So Westfield shopping centres, they can be owned in a unit trust. They've got many tenants in their shopping centres that are paying rent. So not only do we get the capital growth of that overarching asset that grows, but there's continued rent that gets paid from their tenants. So that's a really great asset to hold. So they're probably the growth sectors that we'd be talking about. And then we've got our more defensive positions in our portfolio. So we bonds and credit, and then cash. We'll steer away from cash at the moment. Everyone understands what cash does. But bonds, that's essentially those defensive positions in the portfolio, which is kind of like a loan to either a corporate or the government or a bank. So a government bond, for example, they might give you 2% interest rate or yield on a bond. That's so that they can go and invest that money back in the economy to stimulate the economy. You can get some higher yields from more corporates, but essentially it's a loan to that particular institution or corporation. that gives you those returns. And then we have alternative assets. So we believe these really form a great part of our portfolios. And a few of the different things that fall into that alternatives category. One is precious metals, so gold, silver, again, palladium, platinum, those things that we may use for different industries. But then we use a really unique fund in our portfolios that invests in really quite unique areas. One of them is water rights. They've got student accommodation. They've got some agriculture. But these are really, really great defensive but alternative assets that can provide growth. Water rights, for example, a lot of farmers and agricultural providers need to rely on those water rights in drought periods. They're paying for licenses to pump out of creeks and dams, and this particular fund that I'm mentioning, they actually have these water rights to be able to sell on to these farmers. So really, really great asset that's just different to a normal standard portfolio. So I'll just finish on a bit of a market update. So at the moment, we've had a really great start to the year. January was really good for a lot of areas or regions. I think as of today, Europe was still up about 15% from the start of the year. So really great, strong start to the year. Australia's had a great start to the year. Then we come into this last week, there's been a bit of turmoil with a couple of banks in the US going broke. So it does obviously add concern and some considerations to what we do in the portfolios. But realistically, there was a lot of internal things that happened in that bank that have been very, very contained. Overall, the Federal Reserve over in the States have done a fantastic job of trying to make sure that there's no contagion to what's happened with these banks. But essentially, as their deposits were coming in, they were buying bonds from the government. So long-dated bonds, which means that they were getting, let's call it 2% return on those funds that they're investing. So if you as a depositor invest money with the bank, or put money in the bank, and they say, oh, we'll give you a 1% return, they obviously have to find that return from somewhere. So they go and invest it into government bonds, those sorts of things. Problem was, as interest rates were going up across the board, they're then offering a higher interest rate on your deposits. But the money that they were making off those bonds wasn't backing that up. So you had this differential between what they were making off the money that you had deposited and what they were offering you as an interest rate on your funds. So when people started redeeming their deposits, they didn't have enough money in the kitty to be able to pay all of that out. So that was where the detriment of those couple of banks come from. So realistically, it can be contained, but it's one of those spaces that we are definitely watching. So on that, I'll hand back over to Vanessa to take us from here. So she's going to talk about risk profiling and how to find out, where we're going to invest the money for you guys. So what's going to be the most suited. So.
Yes, risk profiling. It is incredibly important because with everything that Dane was talking, we need to understand how much money we allocate to cash versus shares, as a stark difference. And the way we do that is by going through some questions, and these questions will help determine how much risk you take. And off the back of that, Dane will be working hard with his team to invest the money into the right sectors to help you get a great return on your money. So inside, before we go to your booklets, I just want to explain the risk return sort of trade-off. So when we're talking low risk and low return, we're going to start out with cash. That's really the lowest risk, but also the lowest return that we've been looking at long term. And if we think about 12 months ago, a term deposit, you'd be lucky to earn 1%. And where we are now today, we're able to get our clients 4% and beyond for just a 12-month deposit. So that's quite exciting, but it still is low risk, low return. That's a locked in, very low rate. Where we move to from there is bonds. So it's a slight increase on the risk scale, and we should be able to earn a slightly better return in doing that. And so Dane talked about bonds. From there, the next spot would go to a higher yielding product, and we normally refer to them as hybrid securities. So I know Dane didn't touch on those, but we do hold those in our portfolios. And what they are is simply when the banks are looking to raise capital, so we're talking about our banks here in Australia, they will say, so separate to a term deposit, we will give you the cash rate, so we'll give you the cash rate, plus we're going to give you a coupon. We're going to give you a premium because you gave us your money. And that premium will be a locked in amount. So as an example, the cash rates, the income you can earn in cash right now is about 4%. So we might find one of these products where they say, we'll pay you 4% plus a premium of 3%. And so that's why we're saying it's a little bit more risk, but we'll certainly be earning a higher return than we would down here. So these are sort of the things that we'll be looking at in our defensive bucket when we're looking for protection and security for people that are more in that retirement or needing access to money soon. And then we move on to assets and are now starting to move up on the risk scale. And we start with property. Property we are taking more risk because the capital can fluctuate. It can go up in value, it can also fall in value. But for doing that, if we hold the asset long term, we are almost guaranteed a better result. There never is any guarantee in investments. But if you think back to that chart that I showed you earlier, if you've got the right professional advice and you hold these assets long term, we know that they're going to grow over time. So that's property. Then we moved into developed countries and their shares, so the companies within those developed countries. And then the final spot we'll end up is emerging markets. So there's some really great opportunity if you're willing to take some risk in emerging markets, and that's certainly a part that we look at internally. But that kind of just sets the scene for the questions that we're going to go through. And what we're going to do is we're going to try and understand how your money should be allocated between all of these assets. So this, you might be thinking, how does this apply to me? Well, if you have superannuation, this applies to you because this is how your super is invested. It will just be a mix of all of these investments. If you have a pension account, so you saved up money, you retired, again, same thing. If you have an investment account, so you've got some money that you're investing that's separate to your superannuation, something you can access, it will be invested the same way. So these set of questions I'm just trying to point out are really important that we go through to get the asset allocation correct. So in front of you, you will have a little booklet, and if you're online, you should have the booklet as well. If you don't, just a reminder to email us or put in the comment box, and someone will kindly send you an email quickly. But you'll see, these questions. Now, what I'd like us to do is, I'm not going to ask anyone to read out any answers, but I would like to go through this with you together so that we can talk about how the answers, how you can have this benefit you at home. So, first question that I'll ask, how would you rate your willingness to take financial risks? So it should be just a quick answer. I don't want you to think about it for too long. Which box do you fit into in regard to a risk taker? Next question. How familiar are you with investment markets? Are you sitting here going, Dane, thank you very much for explaining things. I had absolutely no idea what a share or a stock was. I appreciate the definition. Or you say, yep, that all makes sense. I understand, I'm experienced with all asset sectors, and I understand various things that impact performance. So have a look between those different ranges and
like, were you the person that was going to correct me and tell me dividends was the word that I was looking for?
I thought you were looking for dividends. And then third question. So how would you describe your experience and understanding of investment markets? So first of all, have you had positive experience or negative experience? That could be in property or it could be in shares. Or you're not very familiar and you're cautious. Now, the fourth question. What's the most aggressive investment that you have made? Do you simply only have savings? Or do you have superannuation, so you might be exposed to managed funds? Have you bought your own home or investment property? Or do you hold some shares? So that should be an easy one to just select for your experiences. Now we're looking at time frame. So once your investment is placed, how long before you're going to need to access the capital? So we're not talking about the income that you might receive, but how long until you need to access like large chunks of capital? So as an example, you might be thinking this is really long term, I'm just going to put this aside and I'm not going to use it for 7 years. You might be thinking, I want to buy a property with it, but I do want to park the money somewhere for a little while and it might be a shorter term. So timeframes are super important. If you think back to that graph that we were looking at earlier that started in 1950, and if you've got a short time frame, we're really not going to want a lot of exposure to shares, if any. Depends on what your time frame is, because we want that capital to be there if you need it soon. If it's long term, then we're going to be looking at some shares and some other things to help you grow that wealth. Then we move on to inflation. So inflation, everyone will have heard that term, that word used, because it's flying around the news everywhere at the moment. Because we do see the cost of goods at the moment increasing, whether that's our fuel increasing, whether it's the loaf of bread, everything's going up in value. And what that means is we have less money to spend because we're spending more money on goods. So with that in mind, how much risk are you prepared to take to counter the effects of inflation? So if we put the money in a bank account, we may not be beating inflation. Inflation might be going ahead quicker than us. So therefore, we're actually losing money. It's a really important question to ask ourselves. So, are we comfortable with some short to medium term losses, a bit of volatility in order to have, in order to beat inflation over the long term? Have a think where you're comfortable there with that question. Then we move on to volatility. So volatility is something else that we would all be quite familiar with in the market at the moment, because coming out of the back of COVID, we have seen markets quite volatile. So most investments are going to fluctuate both up and down. We're wondering, how much could your investment fluctuate over a 12-month period before you feel concerned and anxious? So we know if we're investing, we're not talking about a bank account here, we're talking about investing, that we're going to see some volatility. How much are you prepared to see that go up and down before you actually go, I'm actually feeling really concerned and anxious? Because we need to know the answer to that, because that will help determine which investments we place you in. As an example, $100,000, if that fluctuates 5%, we're talking $5,000, it's gone up or down. $100,000, if it fluctuates 25%, well, that's $2,500. Think about $1 million. $1 million, so you might have a different answer if you've got $1 million. A 5% fluctuation on $1 million versus a 25%, we're talking $250,000 fluctuation versus the $5,000 fluctuation. So, next question regarding volatility is, what would your reaction be? 6 months from placing your investment, you discover, in line with what's happening in all investment markets, your portfolio has decreased 20%. So, you think about your earlier answer, am I feeling concerned and anxious, or am I going, well, that's part of the investment, that I'm in, I'm comfortable, I've got good quality assets, I've got great professionals that are looking after the money. Would I invest more money because the market's fallen? I want to take this opportunity to make some really good money. Or would I just like to hold it and wait and let those assets recover? Or am I feeling quite fearful and wanting to sell my asset because it's dropped that 20%? And do I want to liquidate and take that loss? Again, really important how you answer those, because that's going to help us determine, do we take high risk or low risk? Okay, next, there's a few more questions. Now we're looking at performance. So everyone, when I ask about performance, us as advisors, normally people will say, I want the highest level, the highest amount of performance. But we need to be realistic with that. Depending on how you've answered other questions, will determine what level of return you're going to receive. So over the long term, what do you reasonably expect to achieve from your investment portfolio? So if you're taking high risk, I'll help you out here. You'll be looking at the higher numbers on the page. If you're looking for something low risk, you'd be going for the lower numbers on the page. Next question. Have you had an investment, which may include your superannuation, fall in value, and how did that make you feel? This was always a great question to ask because normally over time we've had investments and they have gone up and down in value, and have we not even opened our statement, our super statement, to see what the result is? Or is it something that we're checking, we're logging in and we're looking at, every day? Next question. So what degree of risk are you prepared to take to achieve that desired return? So if you put in there, I'm looking for an 8% return and above, we would expect that you're probably comfortable with a higher degree of risk. That's going to be acceptable for a larger increase in potential returns. Or if you selected the 2 to 4%, we would quite understand if you listed, security of capital is required regardless of potential returns. Couple of questions left. So now we're looking at income. What's your future income requirements? With this investment, are you looking to receive income? Or is your primary goal to increase the capital? Think about a property in this regard. When you have a property investment, sometimes people are buying it because this property is going to grow in value. They know they've purchased it at a really great price and it's going to increase. Whereas other people will purchase it really thinking about the income that it's going to provide to them. That happens with all investments, as Dane was talking earlier about dividends. Dividends is the income that's paid on shares. And are we doing this investment for the income or for capital or a bit of both? And the final questions are now about borrowing and your experience. So have you ever borrowed money to make an investment? Has it been for property, shares? Is it an investment property? Or would you even consider borrowing to invest? And then final question, if you are in the position of considering borrowing to invest, how does that borrowing make you feel? Do you feel comfortable about it? Do you feel cautious about it? Or concerned? Now, if you take a moment, I'll give you a moment to add up those scores, because those scores are going to tell us what sort of investor you are. It's like magic. So you should have a score somewhere between these ranges, 57 or 18, somewhere around there. And that will determine whether we're going to be looking at investing a lot of the money into shares, or whether we're going to be looking at more of a moderately defensive portfolio. We're going to look to protect the capital that you've already accumulated. So this is a really important step when we're looking at managing wealth. Does anyone want to share with me? You don't have to, but did anyone want to share with me their answer?
Yeah. There's more time to get.
Okay. I will give you a couple of minutes. Thank you very much. We have a 45. Excellent. So you're a balanced investor. That's what it's telling us. Now, so your portfolio should be focused on capital, but there's some need for income. So with that answer, what we would do, thank you for sharing, is what we would do is we dive deeper there and we go, okay, that's where how comfortable you are with regards to investments. And then we're going to open that up to explore more. Is it a short-term investment? Is it a long-term investment? If it's a short-term investment, we might consider, well, we'll come out here, do we need to still lower the risk? As a professional, do we think that that's too much risk? Or is it the opposite? Have you got a lot of time on your side? Can you afford, is it our job as professionals to help you now understand risk versus return and give you more education so that you can take a little bit more risk, which will help you achieve a better return? So that's what we do a lot here at Positive Dynamics with our clients, and Justine sitting with us. Justine would spend a lot of time educating clients. And it's not always, we might start out as a balanced investor, and then as we build up more confidence, we might also change that profile. Or as we near retirement, we might recommend reducing that profile. into a more conservative position, which is something that we see when people don't come in professional advice. They don't even actually know to make these changes and the impact it can have if you do or don't. Yeah. Anyone have any questions on that exercise, or anyone else want to share an answer?
I'm 39, so I'm balanced as well.
Yep.
Lower balance.
Lower balance.
But I think it's interesting what you said about maybe being too cautious
Yeah.
and having another opinion.
That's it. And that's all it is. And then it's just having a professional there to talk through how you've answered those, what you're thinking and feeling, and help work through so that we can help you with the best profile. But so what all of that means, so then we take that back to Dane and the investment committee, and we work out how we're going to allocate the money. Now this will change, as Dane was saying, depending on where the market is at. But as a general, this is our internal way of allocating money. So let's say we're a balanced investor. What we'd be looking at is about 40% of your wealth in cash and fixed interest, very secure. Then 60% of the money would be exposed to shares. So we'd expose to whether it's the Australian market or overseas markets, maybe a little bit of emerging markets, and some property. And that helps us have that allocation, and it gives us a benchmark to stick to make sure that we never take on too much risk than you're prepared for. So when we talk about volatility, we know this portfolio should not be dropping more than 25%. You know, this portfolio probably is going to fluctuate around the 10 to 15% mark. Doesn't mean we're not going to have some really great years and we're going to have some much better returns than that. It just means that's generally where we're going to sit. Yeah, and then on the other side, an aggressive account would mean that we just don't have any cash and fixed interest. We're diversifying now across all of the different shares. And for our retired clients or clients that need access to capital, we'll be looking at this end, where we're really wanting to preserve a lot of the capital. We might have 50 or 60% of the money sitting in cash or fixed interest products. And then the balance of the money, whether that's half or less, in shares. And that's how, when markets are volatile as they are right now, we look at our clients with these profiles and they don't move very much in percent. So when times are bad, they haven't lost a great lot when we talk percentage terms. It's only when people have very large balances. So when I asked you to do an example on 100,000 versus $1 million, there's a very stark difference. So when we get a small fluctuation on an account of, someone that has $2 million, they start to really notice those fluctuations. If you've got 100,000, you generally don't notice so much. So now let's think about your financial plan. Do you have a professional advisor? Do you have someone to help you make sure that you make all the right decisions? And are you diversified? Do you have a backpack with only socks in it? Is the rest of your body exposed? We think about that backpack, think about your investments. Do you only have property? Do you only have cash? Because if that's your reflection, then you probably should consider some diversification. Because we know through many, many years of research and by actually managing wealth for 17 years, that that's how we secure and ensure that people get the best results. So diversification, professional advisor. We want to help you live your life by design. And to do that, we need to plan, we need to prepare, and we need to take action. So they are some 3 very easy steps. And for us to help you do that, we would suggest that you book a free 20-minute starter session with one of our advisors. Justine's here tonight. Justine would love to book in a time with you. So if you have some time before you leave, please just quickly have a look at her calendar. And for those online, please send her an email of a preferred time that you have. Because we would love to actually have a look at your position, have a look at your risk profile and see what changes we can make to help you make more money, have better protection, all of those things. One thing I'll point on, earlier in the slides, we talked about cryptocurrency, and you'll notice through the rest of everything we've talked about, we didn't mention crypto. That's because crypto isn't regulated in Australia. And until it is, it's not something that we're going to want to play with for our clients. But we do have some seminars that are just built 100% for crypto, because we do like the technology behind crypto, and that's why we talk about it here, and we can invest in the technology. But it is very, very high risk, and it's not something we do for many of our clients. So I thought I would just put that out as well. So inside your little pack that you've got, you'll find on the final sheet, you've got a feedback form. If I could ask you to fill that out, because we would love to hear your feedback. It helps us improve, but it also gives you an opportunity to write down your name and contact details, so that if you don't have a chance to just talk to Justine tonight, we can certainly reach out. And while you're filling that out, I'll just tell you that we do have another seminar coming up in a fortnight. So not next Wednesday, the Wednesday after, we will have a seminar talking about tips and traps to avoid ruining your retirement plan. So it is designed for anyone to join, but the people that will gain the most value would probably be people that are leading into retirement. So it could be anywhere from, early 50s. You could even be retired. You could be 65, 67, even 70 and retired. You'll all gain a lot of benefit from this seminar. So please join us either in person or online. And I would like to share, I've been doing a lot of talking, but I would like to share all of the services that we do here at Positive Dynamics. Wealth management is a very important part of what we do. It's what we spend a lot of, Dana spends all of his day looking at the management of wealth. But we do help people when we're talking about wealth management with the superannuation strategies. So it could be how the money's invested, but it could be contributions, tax minimisation, beneficiary nominations, the insurance within the fund. We also give strategic advice regarding property inheritance, sale of a business, lots of different times in people's lives that we'll be helping. So that's a bit more about what we do here at Positive Dynamics. Now, question time. Does anyone have any questions? Justine? No? Well, we can hang around and
You would be higher than
Well, for those that are online, thank you for joining us. If you have any questions online, you can pop them in the chat. We do have Hayley and Florentina out on the computers, so they'll bring the questions into us. But yeah, I really appreciate you taking some time out to come listen to Dane and I, and we hope that you gained a lot of value. We hope to see you again.
Thank you, guys. And can I just point out, did you see those magnificent transitions on the image? So Samson, our son, actually helped Vanessa with those transitions on the PowerPoint.
That's amazing.
All the
I
flash.
know.
Yep, he's getting ready for school. He's getting ready for school, and I said, I got my presentation today. I said, oh, Mum, I've got to help you. I've got to take you through your presentation.
He gets very excited to help with that sort of thing.
And when you did the first one, I was like, wow.
Oh,
Good job.
yeah. Yeah, so did anyone, did you enjoy doing that
Very
profiling? Has anyone seen a profiling questionnaire like that? No.
Did it make sense to actually understand, that level of risk that you'd like to take and how that would be impacted, from the perspective of investing in shares, having it in cash or as bond products?
Yeah, we often see, I'm making assumptions here, just looking at you, that you've got time on your side until you retire.
Yeah.
And same, Linda. But your circumstances may be different, and I don't know, we're not going to get into that. But we often see that, as Justine said, and part of what we do is then, help understand, well, If this is a retirement strategy we're looking at, our job is to help you potentially take more risk, because we know, we think about that chart that looks from 1950 to where we are today. We know we're going to help you make so much more money if we just put more allocation to shares. That's all we're talking when we're talking risk, really. It's just a different asset class. It's going to be more volatile. Some people think that risk is a chance of me losing my money. With how we manage money, the chance of you losing all of your money would never exist unless everyone in Australia was, banks were closing down and it was a war, there's bombs going off, like for you, and then it wouldn't matter who's looking after your money, that's going to be the same event. So that's why we know by helping clients when they've got more time on their side, take some more risk. It just means there's going to be more volatility, more ups and downs, but over the long run, you're going to make a lot more money. And when the market is more volatile, what we do for our clients is we do a lot of videos. So Dane will often get the camera out and say, hey, the news this week, 2 banks in America went broke. This is what we're thinking. We just try to, 1, give you some awareness and understanding, but 2, make sure that you're not being fearful and going, well, I need to sell my investments. Because it's when you sell your investments, that's when you really see the losses. And normally with time, things will be okay.
So how much money do you actually need to be able to manage it? Like you're talking about, on one hand, millions, on the other hand, 100,000.
So yeah, good question.
A financial advisor, do they have to advise the whole finances, or can they advise a certain portion?
So sometimes we'll have new people come, just walk in. I'll see us drive past, and they'll be driving past for a long time. They'll just walk in, and they'll ask exactly that same question. And what we say is, you should always have a complimentary meeting with us, because we would be happy to donate our time to help you have a better understanding on investments. Number 1. So I know Hardik did one of those yesterday afternoon. It was an existing client who does have millions of dollars, and someone that they worked with, a lot younger. And he came in straight from work in his high vis outfit, and he didn't quite fit the profile of someone that we would. We didn't believe that charging them a fee would add value to their position, so we gave them some free tips. But generally, what we would say is a bit of a rule of thumb: if you've got 200,000, we can help you now, and we can also help you ongoing. If you have less than that, so if you start with $100,000, we can help you today, but we won't help you ongoing. We'll set everything up nicely for you. One of our advisors will, and then we'll say come back to us in X amount of years. And that way we're not charging you ongoing fees, but we're able to get you set up properly early. Or if you've got less than that, then we might just give some free advice in a very short meeting. Yeah. Good question. Thank you. Yeah. And we talk about that. Superannuation is included in that bundle. A lot of people don't think about the superannuation, but for most people, that is the biggest asset from what we see, because it's compulsory in Australia and there's money just pooled in there. And it's probably the most neglected asset that we see.
Yeah, absolutely.
Because it's compulsory, they haven't set it up, they give it no thought, and they think, well, my employer must be doing the right thing. But the truth is, the employer has nothing to do with it. It's a separate company that potentially they've never had a meeting with. So a lot of the work we do here is around superannuation. But
Obviously, some great regulations by the government around where that money is invested in super that they've never looked at. But really, there can be so many better options for clients that have never paid attention to that superannuation portion. I'll be there someday. It's not really my money at the moment anyway. Realistically, it is your money, and it is something that people should take care of.
What's the average age of your clients?
what would you say is your average age of your clients, Justine?
Depends which advisor. Do a lot of work with retirees, but I tend to be older, whereas Hardik's clients probably are younger clients. Yeah.
That doesn't really matter. So
Because everyone has different needs at different stages in life. Yeah, so
Does the financial planner have to have a global picture of your life? Can you not just say, it's 200,000, do something?
Yeah, look, that is part of what we can do, absolutely. So that's one of the things that.
It's like, oh, fine.
Yeah, no, it's absolutely part of what we can do. We've got a few clients like that, the investments that we hold, all of them are like a plan B because they're very wealthy and that's just like, that's their money that they go, we'll just set that aside. Again, it's one of those things, they may not even have to be wealthy, it might just be they're only comfortable to let someone else manage that money for them. But on the flip side of that, we also have clients that, let's say, late 30s, early 40s, they've got a house there, they've got some equity in, they've got some super, they've got some savings, and they go, look, I just want to be wealthier. What can you do? And they give us everything. And that's where, as Vanessa was saying before on that previous slide, the strategic advice that can come with it about how can we help with that tax situation and minimise tax by making contributions or making investments elsewhere, or how we can help, put some consideration to how we can pay that mortgage down quicker, which then would allow you to have some freer cash flow to then invest for the future and have a better, opportunity for retirement, spending money on holidays, those sorts of things.
Thank you.
Cool.